What if the money in your pocket was never truly yours? Not because you didn't earn it, but because the system you live in was designed to keep you dependent from the start. Today, we uncover the hidden structure behind modern money. How central banks quietly built a financial world where your choices, your savings, and your future are shaped by forces you never voted for. Most people think money is simple: earn, spend, save. But behind those everyday actions is a global system engineered by institutions with enormous power. Central banks. They decide the supply of money, the cost of borrowing, and the value of everything you own. To understand how this machine works, we go back to a time before banks, before interest rates, before inflation. Back to when money was metal, heavy, slow, and dangerous for governments that wanted power. For centuries, rulers faced the same problem: gold and silver limited expansion. War, infrastructure, and empire building required money faster than it could be mined. So governments turned to creative, and often deceptive solutions. They diluted coins, issued paper backed by gold they didn't fully have, borrowed from private lenders. But the real breakthrough came when they discovered something revolutionary. If people trust the paper, you don't need the gold. This insight gave birth to central banking. In 1694, Britain, drowning in war debt, struck a deal with private merchants. They would lend the government money, and in return, they'd gain the right to create the nation's currency. The Bank of England was born, the model for every modern central bank. For the first time, money could be created through loans, not metal. Debt became the engine of currency creation, and citizens became the silent collateral. Other nations copied the formula. Debt grew, banks grew, and with them grew the idea that money and dependency were inseparable. For centuries, gold acted as a limit. You couldn't print endlessly, but wars, depressions, and global pressure pushed governments to break that rule. In 1971, the United States ended all gold convertibility. That moment changed everything. Money no longer represented value, only obligation. Central banks could expand supply at will. Commercial banks could multiply it through lending. Every dollar became someone else's debt, and the system shifted from wealth creation to dependency creation. Cut off from gold, money supply exploded. Governments spent more, banks lent more, and ordinary people paid the price through inflation. Your savings lost value. Your salary bought less. Your living costs rose even when your income didn't. This was the invisible tax, the quiet erosion of purchasing power. Meanwhile, central banks and financial markets grew richer because the system rewards those who create credit, not those who work for money. Whenever the system cracks, recession, crash, crisis, central banks respond with the same playbook: print more, lower rates, increase liquidity, buy government debt. These aren't solutions. They are temporary patches that make the next crisis worse. From 2008 to the 2020 pandemic, the pattern repeats. Debt is used to solve problems caused by debt. Governments become addicted to borrowing.